Hello everyone, my name is Tristan Thomas with TrisTom, and today we're going to be going over the Indexed Universal Life Policy. Now with so many moving parts, it can become confusing for both the agent as well as the client. So our goal today in this video is to help simplify the policy for you so you can pass it on to your clients. Now, like I said, what we'll be doing is understanding foundationally how the IUL works, going over certain terminology associated with the IUL, and we'll simplify it so you can describe it to your clients, giving them the advantages and the disadvantages of the IUL. Now, you as an agent need to understand that the IUL does not fit for all of your clients. It's a very small group of clients that this actually fits for. But for the ones that it does, it can be truly beneficial for them. Also, we'll be going over 4 main areas that you as an agent need to focus on to help build credibility and trust with your clients. Now, depending upon exactly which policy your client chooses, whether traditional UL, an indexed UL, or a variable UL, you as an agent need to realize that all 3 are built foundationally the same. So in order to learn more about the indexed UL, let's go over the basics of how a UL policy works. Now, first, what we need to realize is that the cost of insurance, which is based upon your client's age, the mortality rate, as well as other fees associated with the policy, will continue to rise each and every year. So regardless of the age, it will continue to rise, unlike that of a whole life policy where the cost of insurance stays the same. So let's give a particular year and look at the cost of insurance at that particular age. What your client should be doing in the early years is paying a premium that is higher than what the current cost of insurance is. That difference between the current premium and the current cost of insurance will help build the cash value. And that cash value will accumulate based upon a particular accumulation rate. And over time, that cash value will continue to grow. And that accumulation rate is what differs between a traditional, an indexed, and a variable universal life policy. And we're going to focus on that. But hopefully your client has put enough money into this policy and built enough cash value so when they get to a future older age and the cost of insurance is now higher than what their current premium is, the way in which to pay what we call the funding gap will be done by, 1, the excess cash value, or secondly, more premium that your client is willing to put into the policy. Now, this is the reason why a lot of universal life policies lapse. That the client hasn't built enough cash value to sustain the policy, or they're unwilling or unknowing that they have to actually add more premium into the policy to keep it afloat. And this funding gap, or the building of the cash value, is the benefit of that indexed universal life policy. The hope here is that you're building enough cash value over the life of the contract to make sure that in future years the policy stays in force. So now let's go over the variations a little bit more in depth of a indexed, a variable, and also a traditional universal life policy. We have to keep in mind the UL policy's volatility as well as the cash value accumulation potential. And it's based upon, like I said, the volatility and the potential for the cash value to increase. Now, the UL that has a low volatility, but also has a low potential for cash value accumulation is the traditional UL. One that's a little bit higher in volatility, but a little bit higher in the cash value accumulation potential is that indexed universal life because it's following a particular index. And then for another video, we'll go over this, but one that has a higher volatility and a higher potential for cash value accumulation is that variable UL, because that's being increased based upon the equities that you and your client select. Now, so there's certain things that you as an agent need to understand, certain terms that you need to focus on. Well, first thing you got to realize is that the indexed UL is credited by a selected index. Now, depending on the carrier that you choose, they give you different options on different indexes or indices to follow, such as the S&P 500, maybe it's the NASDAQ, maybe it's the Russell. You need to look at the different types of index and select one. And that's the one in which this policy will follow moving forward. Also, you need to be understanding of exactly what a credit rate is. So this is a point that we need to focus on. A credit rate is the amount added to the cash value every anniversary date. It's the credit rating that's going to build the cash value over time, and it will occur once per year. Also, you must be aware of what they call a floor credit. A floor credit is the minimum amount of growth on the policy that happens per year. Regardless of a down market, this is the lowest credit rate that your client can actually get on their cash value. It can never fall below that number. Also, we have a cap credit. Now, the cap credit is the maximum amount of cash accumulation, or credit rating that your client can get on this policy. And that's the highest that it can get, and there's no further amount that it can increase in that particular year. I'll explain exactly how that works further. And lastly, you need to be aware of the participation rate in this policy. Now, a participation rate is the credit rate given to the cash value based on an index performance. Just to give you an example, if you have an 80% participation rate in the IUL, and let's just say that there's a 10% growth with the index that it's following, you're going to get 80% of that 10% growth. Therefore, you'll have an 8% credit rating on the policy for that particular year. Now, let's go over exactly certain scenarios to make you understand how this policy works. Let's just say that the index that you follow is the S&P 500, and we have a good year. And we look at your current policy. So let's just say that the anniversary date on your policy is July 1st of 2016. The cash value that you look at, you see that it's $100,000. And from July 1st, 2016 to June 31 of 2017, you look at the S&P 500 and you see that it's up 10%. That's a really decent year that you have. Now we got to focus on the terminology that we had discussed. One, we got to look at that participation rate of the policy. In this case, we're saying that the participation rate is 80%. We look at the cap credit, and we see that the cap credit is 10%, and the floor credit is 0. Now, being that we had a good year, the two things that we need to focus on is one, the S&P 500 growth, which was 10%, as well as that participation rate, which is 80%. So since we're looking at those two items right there, we notice that we need to credit you 8% because you're getting 80% of the 10% growth. Therefore, we take your 2016 anniversary date cash value of $100,000 and we add the $8,000 of credit. Therefore, in July 1 of 2017, your cash value is now $108,000. Right? So let's go into another one. Let's just say that you have a great year in the S&P 500. Again, we're looking at your anniversary date, and we see on July 1st of 2016, your cash value is $100,000. Again, what we look at, again, is from July 1st, 2016 until June 31 of 2017. That entire year, you see that the S&P 500 has grown 20%. Really, really good year. Again, we got to look at the certain things, such as the participation rate, which in this case is still 80%. We still have a cap credit of 10%, and we have a floor credit of 0%. Now, you would think if I'm taking the S&P 500 of 20% and looking at a participation rate of 80%, I should get a 16% increase on my cash value. But you got to keep in mind that cap credit. That cap credit is the next item that you got to look at, and you realize that there's a 10% cap. Therefore, there's a 10% cap. You won't get 16, you'll get the cap of 10%. Therefore, on July 1 of 2017, your credit amount becomes $10,000. Therefore, you have a cash value on July 1 of 2017 of $110,000. Right? So now let's talk about the other scenario that's out there. The last scenario is a really bad year. So let's just say again, we have July 1, 2016 of a cash value of $100,000. Again, we look at July 1 to June 31 of the following year. We say that the market was not that good. The market actually was down 8%. Well, the things that we need to focus on again are, one, what is the participation rate in the policy, which here is 80%. We see that the cap credit is 10%, and we see that there's a floor credit of 0%. Since we're in a down year, the only thing that we truly need to focus on is that floor credit. And we see that it's 0%. So, being that a floor is 0%, your cash value credit would be 0. Your cash value last year was $100,000, and we're going to add in 0. Therefore, July 1 of the next year, you're going to have a cash value exactly the same as it was in the previous year of $100,000. So that's the way in which the Index Universal Life policy works. You as an agent need to focus on what does the index do in that particular year, what is the participation rate, what is the cap credit, as well as what is the floor credit. Those are the 4 areas you need to focus on. So just to re-emphasize all of that, one, when you're looking at the different types of carriers out there, ask yourself first, what is the floor credit on this policy? Now, just as a rule of thumb, the floor credit is usually 0%. If it's lower than 0%, you should be looking at other carriers that are out there. You should also look at exactly what is the cap credit on this policy. Normally, a cap credit is about 11.5% as of 2016. But the higher the cap credit, usually there's more fees associated with that. Now, if you do see policies out there that have a cap credit above 15%, be cautious. Why would an insurance company give you a cap credit that is so high? Usually there's fees associated with that, and they're just trying to sell the sizzle as opposed to actually truly giving your client a benefit. So be cautious if you have a very high cap credit. Also look at the participation rate of a policy. Now, usually a participation rate is anywhere between 50 and 100%. If you get 80%, that's pretty good in that case. But be skeptical of participation rates that are above 100%. Sometimes you'll see policies out there, and it blows my mind, but you'll see participation rates of 110% or 120%. Be cautious. Why would an insurance company give you something that is above what the index that they're following is? It just doesn't make any sense. Find a different carrier out there. And also the last thing that you should, and I just want to reemphasize this since this was more of a mute point before, is the target rate, the target premium that your client pays into the policy. Premium that is above the target rate will help increase the cash value quicker. And premium that is below the target rate will limit the upside of cash value accumulation. So, rule of thumb is if your client can afford it, and if it is possible, have them pay something that is close or above whatever that target premium is. Now, other items that you need to do, remember about the IUL is number one, IUL policies are not for every client out there. It fits a small group of individuals, but for the individuals that it does fit, it can be truly beneficial. And it also can be very confusing. It's confusing for agents, therefore it's confusing for clients. So simplify and stay patient with your clients. Also understand that client needs and whatever the client's needs and wants are should be solution-based. So you need to figure out exactly what is the best solution for their particular situation. Maybe the IUL fits, maybe it doesn't. Also also your clients to make a better decision. Here at Trist-Tom, we really do focus on empowering your clients, being fully transparent on how these policies actually work. So, tell your clients the good and the bad of the policy and make them understand how it works. And lastly, you gotta focus on the need. Don't focus on the sale. Now, my name is Tristan Thomas, and I'm with Trist-Tom. And if you haven't already checked out our website at www.tristtom.com, you're doing yourself a disservice. We are your one-stop shop for all of your life insurance agent needs. What we're doing is we're providing life insurance sales training just like this one here, but we do it on a one-on-one basis as well too. We also offer case management consulting, So if there's a policy that you're working on and you're wanting additional help, we look at all the policies that are out there and we look at your client's situation and we match it up accordingly. We also offer a complete client relationship manager. Think about it as a very simplified Salesforce where you can upload all your client's policy information, applications, signature page. You can pull it up on your phone if you're in a meeting, but you'll never lose any paperwork ever again. Also, for the independent agents out there, we have access to over 70 different carriers. So if you are looking for a new IMO or a new GA, we have the ability to help you on that end as well too. We have a company that we use that we can help match you up with. You can upload all of the files and application, all the paperwork. You can track a policy from start all the way to completion through tristom.com. And the great thing about tristom.com is it's completely free to sign up. So at the very least, sign up, check it out. My name is Tristan Thomas with Tristom, and we hope that this video has helped you become a better agent. Thank you and have a great day.